Okay, so you want to get smart fast, right? We're all about that. And today we're diving deep into this legendary book. It's called The Intelligent Investor by Benjamin Graham.
Yeah.
This book came out in like 1949.
A while ago.
It still like totally shapes how the best investors think about things.
Yeah.
I mean, even Warren Buffett says it's the best investing book ever written.
He's a big fan.
So we're going to pull out the core ideas here so you can make smarter long-term investments without like getting lost in all the Wall Street blah, blah, blah.
Yeah, exactly. No jargon.
We'll be covering value investing, the difference between investing versus speculating, this kind of weird idea of Mr. Market, why something called margin of safety is like your secret weapon,
Yeah.
different ways to actually approach investing, and then the whole like keeping your cool thing when the market's going crazy, looking at the numbers, the fundamentals, and like steering clear of all the hype.
Right.
Sound good.
Let's do it.
All right. So what's really fascinating to me about Graham is that his ideas from way back then are still so relevant today.
Oh, absolutely. Yeah. His insights are like timeless principles. They cut through all the noise,
Yeah.
all the noise of the market,
Totally.
which there's a lot of. And I think maybe to like start off, a good place to start is that core distinction he makes between an investor and a speculator.
Okay, let's talk about that. So for someone who's like me, just trying to build wealth like responsibly over time,
Yeah.
what should we really take away from this whole investor versus speculator thing?
Okay, so Graham basically saw the investor as someone who actually does their homework right. Like they actually research companies and buy stocks with this long-term view. You know, they're focused on the actual business, not just like quick price moves.
Right.
The speculator, on the other hand, is more about trying to like predict those short-term price swings,
Gotcha.
almost like betting or gambling.
Oh.
So the big takeaway is to not treat stocks like lottery tickets. You got to understand the underlying value of what you're buying.
It's about ownership, not just like odds.
Yeah.
Okay, that makes a lot of sense. And this whole Mr. Market concept has always kind of thrown me off a bit.
Yeah, it's a little out there,
Yeah.
but it's brilliant.
Yeah.
The brilliant way to understand how volatile the market can be.
Okay.
So picture this. You have a business partner named Mr. Market. Every single day, he comes to you and he offers to either buy your share of the business, which is like your socks, or sell you more.
Okay.
But here's the thing. Sometimes Mr. Market is like way too optimistic, you know, like irrationally exuberant.
He's high on something.
Yeah, and offers you these crazy high prices for your stocks.
Yeah.
But then other times, he's super pessimistic, like doom and gloom, practically giving those stocks away.
Sounds a bit bipolar, honestly.
Right.
Yeah.
So the point that Graham is trying to make with this analogy is that you don't have to play Mr. Market's game. You don't have to trade with him every day or let his crazy mood swings affect your long-term view of the company.
Yeah, that makes a lot more sense now. You're not letting like the emotions of the market or this weird Mr. Market guy dictate your decisions.
Right.
You're looking at the fundamentals.
Exactly. It's about realizing that a lot of those daily price changes are just noise.
Yeah.
They don't necessarily reflect the true value of the company.
Okay, so you got to tune out the noise.
Yes.
All right. Now, you also mentioned earlier this thing called margin of safety,
Right.
which sounds really important, especially for someone who, you know, might make a mistake or two.
It's huge.
It is all of us.
It's possibly the most important concept in the book.
Okay.
So think of it like this. If you're building a bridge and that bridge needs to hold 10 tons, you don't just build it to hold exactly 10 tons.
Right. Of course not.
You build in extra strength, a buffer. So maybe you build it to hold 15 tons or even 20 tons
For sure.
to account for unexpected stress or maybe some flaws in the construction.
Right.
Margin of safety in investing is basically the same idea, but applied to like the value of a company. Okay. So you only buy a stock when the market price is significantly lower than what you think the company is actually worth.
Oh, that's interesting.
This protects you if you made a mistake in your analysis, or if there's some bad news that comes out that you didn't expect, or even like a market crash.
So it's like you're getting a discount, like a built-in safety net.
Exactly.
Exactly. Okay, I like that. Now, Graham also talks about like different kinds of investors, right?
Yeah.
What are the main approaches?
So he outlines two main types, the defensive investor and the enterprising investor.
Okay.
The defensive investor is all about like preserving their capital,
Yeah.
you know, like not losing money and avoiding big mistakes.
Right.
So Graham suggests they diversify broadly, investing in high-quality bonds and maybe stocks of well-established companies.
Okay.
The enterprising investor, on the other hand, they're more hands-on.
Yeah.
They're willing to do that extra research to find companies that might be undervalued by the market.
Right.
with the goal of getting higher returns. So it really depends on like how much time and effort you're willing to put in.
It's like pick your level of involvement.
Yeah, exactly.
I like that. Now, one thing I've noticed in my own life is that emotions really can mess with my decisions, especially when it comes to money and investing. How does Graham address that whole emotional side of investing?
He puts a huge emphasis on emotional discipline.
Yeah,
He really believed that investors often lose money not because they picked bad stocks, but because they let their emotions get the best of them.
right.
Like they panic and sell when the market drops, or they get too greedy and buy when the market's really high.
Oh, yeah, I've definitely done that.
Yeah, it's really common. The key is to stay rational, be patient, and just stick to your long-term strategy no matter what's happening in the market.
Easier said than done, but definitely something to work towards. So, okay, let's say I'm trying to decide if a stock is worth buying. How does Graham approach, like, actually analyzing companies?
So he really stressed the importance of looking at what are called the fundamentals,
Yep.
the fundamentals of a company. So that means like its financial health, profitability, and the value of its assets.
Yeah,
Like, is it actually making money?
right.
He would look at things like earnings, dividends, debt levels.
Okay.
The main idea is that when you're buying a stock, you're buying part of a real business.
Right, not just a ticker symbol.
Exactly. And you should be analyzing it the same way you would if you were buying an entire business.
Okay, so dig in, do your research.
Absolutely.
Now, what about trying to, like, predict the next big thing or, trying to time the market? Does Graham talk about that?
He was very skeptical of that.
Okay,
He warned against chasing fads
right,
or trying to time the market perfectly.
right.
His view was that in the short term, the market is totally unpredictable.
Yeah, I can see that.
And you're much better off focusing on long-term value
Yeah.
based on solid analysis.
Yeah. Now, he had some pretty great lines, right?
Oh, he did. Some of the best quotes.
Do you have any favorites?
Yeah, one of my all-time favorites is, in the short run, the market is a voting machine. But in the long run, it is a weighing machine.
Yeah, that's a good one.
It's a powerful way to think about the difference between short-term popularity and long-term value.
Totally.
And another one is, the intelligent investor is a realist who sells to optimists and buys from pessimists.
Oh, I like that
It
one.
really captures his contrarian approach.
It does. And of course, Warren Buffett is like living proof that all this stuff works, right?
Absolutely. Buffett's success is incredible, and it's largely due to applying Graham's principles.
Yeah, it's amazing. So to kind of wrap things up, what are the absolute must-knows that we should take away from Graham?
Okay, so I'd say the key takeaways are focus on the underlying business. Don't just look at the stock price. You got to understand what you're buying. Make rational decisions, not emotional ones. Don't let your feelings run the show. And then be patient. Think long term. And always invest with a margin of safety.
I love it. So the intelligent investor is really about having like a smart and grounded approach.
Yeah, precisely. It's this timeless framework for investing rationally for the long term, focused on value and discipline.
That's a fantastic overview. Now, as you think about all this, consider this. How could this idea of margin of safety, that buffer we talked about, how could that apply to other big decisions in your life?
That's interesting.
Not just your investments.
Yeah.
Food for thought, right? It's a pretty fascinating concept. And of course, if you want to go even deeper, grabbing a copy of The Intelligent Investor is never a bad idea. Thanks for joining us on this deep dive.
Thanks for having me.